Global markets may be rebounding today, but do not mistake this bounce for confidence. Behind the recovery, investors remain worried, anxious, on edge, amid the mounting fears over AI and the massive amounts of money being poured into it. After days of heavy selling in technology stocks, buyers stepped in, US stock futures erased early losses, S&P 500 contracts climbed 0.5%, Nasdaq futures rose around 0.6%. Bitcoin also, in fact, bounced back, rising nearly 5%. After slipping to its lowest level since October 2024, gold and silver found support. On the surface, it looked like calm returning to the markets. But there is still uncertainty because this rebound is not about optimism. It's about investors basically asking one question: has the sell-off gone way too far? Is something deeper breaking here? You see, the turbulence started after fresh concerns emerged about artificial intelligence, real concerns, literally about how much it's costing. Amazon's shares, in fact, fell more than 8% after announcing plans to spend nearly $200 billion this year on AI infrastructure, spending that is rising faster than its cloud revenues, by the way. And Amazon is not alone. 4 major tech firms are now expected to invest around $650 billion in data centers, chips, AI systems this year. And the scale of spending has rattled investors. Many fear companies are racing ahead without clear returns. At the same time, new AI models from startups like Anthropic are threatening to disrupt entire software industries, raising questions about which businesses survive and which don't. And as a result, a sharp sell-off in the market happened, followed by a cautious rebound. Across Wall Street, investors are now trying to separate genuine long-term winners from overvalued hype, just to put this simply. This is no longer just about tech. It's about the entire economic outlook. Because just have a look at the bond markets, for example. Flashing warning signs. US Treasury yields fell, especially at the short end. The dollar also weakened slightly. Investors are now betting that interest rate cuts could return later this year. And as per strategists, there is a new risk: strong economic growth, but also weakening employment, partly driven by AI replacing jobs. A scenario that could also force central banks to rethink policy. So a lot of ramifications here. Meanwhile, the shockwaves are spreading fast globally. In Asia, tech stocks whipsawed. South Korea's index fell more than 5% at one point before recovering some ground. Key suppliers to the AI boom led the swings. Taiwan and Hong Kong tech stocks also coming under pressure. Analysts are saying Asia remains highly exposed to the shifts in AI sentiment, because chip makers sit at the heart of the global infrastructure spending. Despite the volatility, South Korea's market is still up sharply this year. But then investors are also nervous. After such rapid gains, even small doubts trigger big moves after all. In Europe, markets also tried to stabilize. Frankfurt and London gained. Paris, meanwhile, lagged behind. Dragged down by Stellantis, which plunged 25% after warning of massive write-downs, linked to misjudging the electric vehicle transition. The company's shares are now down around 80% over 2 years. A reminder that tech disruption is hitting traditional industries as well. And Bitcoin, which had fallen sharply, also attempted a recovery, but it remains far below its recent highs, showing basically that even digital assets are not immune to risk-off moods. So what does all of this really tell us? Are tech giants spending too much, too fast? Will AI deliver profits, or will it disappoint? And are the markets even prepared for the social and economic impact of automation? This has been a rather brutal week for tech, and the nerves are far from settled at this point. But investors also remain concerned because in the race for AI, no one knows yet who will win and who will end up paying the price. To stay up to speed with the latest news, download the WION app and subscribe to our YouTube channel.